Welcome back to Ask Sloan, everybody.
Sponsored by Zentavos. Keep more of your money.
And we're back with Arturo Lopez, and it's time to sell your business, right? So I have done my 3 to 5 years, okay? I can leave my business for 90 days. I just went to St. Martin for 90 days. I came back. Top line was great. Bottom line was great. My SOPs are good. All of my team is excited, and they're not mad at me when I leave. In fact, they're like, "Get out," you know.
What are you doing back?
Like
what?
you know what I mean, right?
Yeah.
Like, why am I even here? Okay, so it's time to sell. Like, now it's time to sell. What does that look like? Like, like walk us through that. Like, what's the first step? What's my business worth? How do I like?
I mean, I think like any entrepreneur, you want to know what your valuation is. So the biggest thing you want to do is reach out to a firm like Greystone and get a valuation.
Does Greystone do free valuations?
Sure.
Is it like a part of your? Because
Yeah,
I know some firms, they'll like actually give you a free valuation as a part of their due diligence to see if you're ready for them. And if you're not, it's cool. They give you pointers on what to do, blah, blah, blah. But it's just kind of, but other ones, like they want like $3,000, you know?
I mean, usually because the seller's going to get their own. I mean, really the conversation is let's talk about what the current valuation is, because most entrepreneurs have kind of an idea in their head. And what we try to do is get them a very direct and more industry specific valuation versus kind of, hey, this guy in my gym told me his business was worth this. So I think it's important to get a firm that's reputable to do it, because we're going to be advocates for you.
Absolutely.
And we want to make sure your experience is world class and white glove, and make sure we don't set expectations that we just won't be able to meet.
And what's evaluation look like? Like, what does that mean? What do you need from me to start that process?
The first thing you'd want to start off with is, solid financials, preferably the last 3 years.
Okay.
Mm-hmm.
P&L, balance sheet, last 3 years.
Mm-hmm.
Okay. Awesome.
Yeah. And
should I like do anything with those? I just give you my QuickBooks, or like what should I?
I mean, it depends on the comfort level, but the more information you can, give us, we're obviously going to keep it confidential, but the more information, the better. Also contracts are important. And then your internal systems, that's going to be important.
Okay. So I'm showing a profit of like 1.5 million, and I got $10,000 in the bank.
Okay.
How's that look?
I mean, it's interesting. I mean, the profit is kind of in that starting range, which is a good conversation. But I'd definitely be interested in where the cash flow is going.
I mean, bro, I like to live large, man. I mean, I like to rent the yacht in Miami, and every once in a while I take my son on a PJ to the F1 event. So I just like to live large. Is that a problem?
Yes.
Oh, okay.
Yes.
All right.
One of the conversations we have is, the difference between kind of your personal benefit versus your business exit, and that's a spectrum. It doesn't necessarily have to be all the way from one side or the other. But I think with $10K in the cash flow, I think any potential buyer is going to have questions. And, you're going to have really, as the owner, you're going to have very strong arguments as to what those reasoning are. And the last thing you ever want to do is lose credibility or trust.
But it's my money, right? Right. So, and I've got a big family,
Mm-hmm.
and I just like, that's what I like, I'm in the business to have a good time and enjoy my life. Right.
Mm-hmm.
I make money and I spend it,
Mm-hmm.
If I leave, that money will be there for you to spend. Like, you're going to write me a check. And so like that money will be there. You'll have the cash. I won't anymore. I'll have the check that you gave me. Is that a good answer? I mean, does that work? Or how much money should I have in the bank to really give confidence to a potential buyer?
A lot of it has to do with the risk profile. I think kind of a conservative number would be probably 3 to 6 months worth of cash flow, depending on what your operating is.
Awesome.
I mean, I think, we've seen businesses that are closer to, say, 9 to 12 months. That's probably on the other side. What you want is a buyer to be comfortable with the business cycle, dependent upon, what is your client's sales cycle, what sort of up and downs are your industry subject to. And, how often do these kind of cash flow crunches happen? You can also mitigate that with sometimes lines of credit, right?
Okay, so 3 to 6 months of operating capital, 6 to 12 months, even better. How do I do that? Like, how do I get to a place where I can pay my taxes, I can support my family, and I can have $1 million in cash in my business? Like how do I get there?
I mean, the first thing has to be a mindset of intentionality,
Okay.
right? I mean, you actually have to, be in the mindset to sell, not to spend,
Okay.
right?
So it's like a switch, maybe. Like it's not, the beginning is hard. Okay. We've got over the hump. Now it's like, hey, let's dial it back. Let's dial it in. That's a part of that 3 to 5 year process.
Mhm.
I'm gonna say, hey, I bought the Corvette, I did the thing, I had the fun, and now I want to prep to sale. So I'm gonna dial it back. I'm gonna show that the company makes some money. I'm gonna put cash in the bank. Okay, awesome. Let's say I do. Let's say I got that $1 million in the bank
Mm.
when I go to sell. Is that million mine when I sell? Or are they writing me a check and keeping the $1 million? I mean, the million's got to be included in the check, right? Because that's like value that I'm giving them. Like, how does that work?
I mean, it's going to depend on the buyer. I mean, you're going to want to structure, so that you benefit from that cash. But at the end of the day, it's the entity, right? It belongs to the business.
Okay.
And so depending on what the transaction are and depending what your investment banker negotiates for you, then it's going to net,
Okay.
right?
Yeah.
So the check that they write
So
to
I don't need to be afraid of that. I don't need to go rob the piggy bank and make sure that you know what I mean? Like, because I know a lot of small business owners, like, that's my money, bro.
well, then you're going to be compensated for it with the exit, right?
Absolutely.
Whatever that check is it's going to net out that amount,
Awesome.
right?
Okay.
When you
Awesome.
think about, the mindset of getting ready for a sale is, you go to the gym and you understand that your health is going to be a lot different when you're consistent and intentional about showing up than if you only show up once a month, right? And
Mhm.
that's simple. And just the simple way of explaining what that cash flow looks like is that you don't necessarily have to have $1 million in the bank day two, but you want
Yeah.
to be intentional in
No,
that.
for sure.
10 grand is not going to cover you for a rainy day fund or emergencies
No.
or even bank covenants. We haven't
Sure.
even gone into that, but banks are a lot more comfortable and willing to loan you money and support the capital growth when they understand that the cash flow stays in the business.
When you have money, absolutely. And look, guys, we try to make it simple for you. All right. Look, 50% of the profit of your business, that's what you should be taking out for your personal stuff. And you should be leaving the other 50. Okay. That's a short way to figure that number out. And obviously you have to get to that number after you have taken care of yourself and you've gotten through all the initial stages of business development, entrepreneurship, right? We're talking year 3, year 4, year 5, you've reached 5 million annual revenue, so on and so forth. Don't grow your lifestyle with every single dollar that your company is shedding off. Do the 50-50, and then that will help you start stacking that cash and getting prepared to be bankable, getting prepared to exit if the right caller comes, so on and so forth. It's huge. It's huge. So talk to us about the financial statements. Okay. So like give them QuickBooks, but what is EBITDA? Like, I don't like, what does that even mean? Like, what is like, and how do the numbers, because somebody told me once, obviously I'm being facetious, but somebody told me once, it's like, there's my set of books, and then there's the bank set of books, and then there's the tax set of books. And like, obviously, like, this is like the bank set of books, but help me understand EBITDA. Like, what's the difference between a regular financial statement and EBITDA?
So, I mean, this is really your realm, but as we support the entrepreneur and thinking about it, it's what I like to think of the net in the bank, right?
Okay.
Because you have businesses in different industries that have different margins, right? I mean, we
Sure.
have people in the tribe who are doing 300 million in revenue, but their margins are 3 to 5%,
Right.
right? So their EBITDA is going to be comparable to a company doing, say, 15 to 20 million in top line revenue with a margin of, say, 40%.
Right. Right.
Right. And so
Absolutely.
EBITDA is going to be kind of that bottom line on your QuickBooks, what's actually going into the bank after you take care of your operating expenses, your benefits, all your salaries, all of the things that are going to take from the top line enterprise value.
Absolutely. Absolutely. And so the moniker, everybody, is earnings before interest, taxes, depreciation, and amortization. Okay. And what that means, you get to add all that stuff back in to that bottom line. Okay. And so if you've got large depreciation, you've got a lot of interest that you're paying, well, then you're going to be able to add that back in. It's going to increase the value of the sale. Okay. And then we do a multiple on that EBITDA. That's how a sales process go. And that's different than the VC, right? 409A. Like you have these like blown out Silicon Valley valuations that are like a multiple of gross versus a multiple of EBITDA, right? And why is that?
It's a different scorecard.
Okay.
So, most buyers from a EBITDA standpoint are going to be focusing on cash flow, which is that bottom line number. What's in the bank? What does those financials look like? A VC, what you're hearing in the news, social media, they're really looking at the top line on users, subscriptions. And so they're really looking at hyper growth.
Okay.
So that's why a lot of times the numbers get skewed, is because they're not looking at the same numbers.
Right. Value tomorrow.
Mm-hmm.
So that's how SpaceX is worth like $1 trillion and it had a $4.9 billion loss last year, right?
Correct.
Whereas when you sell, it's valued today. And what's the value today? Is the earnings of the business, right? And then what are reasonable multiples? Okay, and I know that it's different between different industries, but we talked about the service industry being hot in the PE market. All the baby boomers that are coming out. So there's a lot of accounting firms that are going right now, like you said, plumbers, electricians, so on and so forth. What are good multiples for those industries?
So I think in the entrepreneurial space, there's kind of three bands.
Okay.
Right. So let's call it sub 1 mil in EBITDA.
Okay.
Right. That's going to be kind of a private buyer, maybe some smaller private equity firms that are looking to do like a search fund. So any of that sub million will be kind of the first band. That's where you kind of start thinking about what an exit would look like.
Okay.
The next one is kind of that 1 to 3. This is when you actually get someone like myself to step in and say, okay, private equity will be interested. This is when the multiples start getting closer to, say, 4 to 6%.
Okay.
You
Or
can
4 to 6x.
4 to 6x.
Yeah. So I did $1 million, 4 multiple. I'm going to sell for $4 million. 6 multiple, I'm selling for $6 million.
Correct.
Okay.
So that second band is kind of that sweet spot where
Nice.
Private equity institutions start paying attention. You have more sophisticated institutions that are looking at you.
Okay.
You get above that 3 to 5 in EBITDA, and that's really where you really is essential to really build a team. And you get those kind of larger multiples that you see, which is above the 4 to 6. It's more of an industry leading because so few businesses are able to get there.
Gotcha. So that's like the 7 to 8 range.
Mm-hmm.
And it's really hard to get out of 8 range. I mean, you've got to have everything. And we work with we know founders, right? And they do a great presentation for Vistage, which kind of really dives into how you increase the multiples of your business. And that monthly recurring revenue is one of those big things that can really drive a good multiple. And so, okay, cool. So I need an EBITDA financial statement, and then I should have a realistic view of 4 to 5 multiple. Okay. And then if I do the math on that and that's not my number, well, then I need to grow revenue, right? I need to scale a little bit further down the road. Okay. But now let's go through the sales process. Okay. We've got our financial statements ready. It's super good. We've got some interest. We got somebody that's like, hey, we're really thinking hard about it. What is quality of earnings? What is that?
So QOV, I mean, it's more of a financial term, but the way we simplify it is it's going to be how bulletproof is a story you're telling a potential seller and buyer about what your financial picture looks like. Right. So that is the quality of your financial team. What do your financial reports look like? Right. Those personal add backs. Can you tell a story and really support the fact that you're increasing cash flow? from that perspective, and then also have a third party look at it and be able to say, yes, this is repeatable, this is consistent, and it's, once the transaction happens, it's able to continue without you.
Does Greystone have an internal team that does that, or do you farm that out to a third party?
Um,
Or does the buyer do that? Does the buyer have their own team that does QV?
So the majority of the time, the buyer
Okay.
is going to have their own QEA,
All
third
right.
party, whether they do it in-house or normally it's a third party, because they want to be independent about it. What Greystone recommends is for our sellers to do their own.
Mm-hmm.
Let's prep ahead of time so that, just like in any good testimonial in court, you're able to go up in front and say, we've already done internal due diligence and we were able to tell the story. So we know exactly what questions you're going to ask, and we've prepared the answers through due diligence.
And so, what does that look like? Am I gathering my invoices? And if I have contracts, I have contracts. If I only have invoices, I have invoices. So, just depending on how I sell, whether it's based on engagement letters, contracts, or invoices. So, I'm gathering those up, and I'm gathering what my bank statements, and I'm basically like matching the transactions to deposits and kind of verifying that these invoices, these payments were, obligations, they were paid, so on and so, like, is that kind of like, is it an audit type process, or is there a different way that they go about it?
The way to look about it is think of kind of a detective, right? It's someone that's objective, doesn't run the business. Their job is to basically find something that they can lower the purchase price,
Gotcha.
right? So what you want to do is
Gotcha.
take away the ability for them by providing them good, solid information. So the higher quality your financial data and your financial structure is, the less of an argument they're going to have to lower that purchase price. And especially if it comes back clean, you gain that trust. Plus, you're able to stay firm on those multiples that you want. Because most people go into the process and, oh, great, they've offered us 4 to 6. But then, you go to your quality of earnings and they're not as solid as you thought.
Yeah, I mean, like, still we're at 4 to 6, but we went from EBITDA of 1 mil to EBITDA of 700. That's a problem. And that can just be an administrative issue, right? The team wasn't doing a great job of maintaining invoices. Hey guys, invoices are serious. Okay, creating an invoice, processing that invoice through to being paid, deleting that invoice, voiding that invoice, like that invoice is very powerful in your business. And if it is not processed properly, when you get to quality of earnings, you're going to have a tough time. A few other things like, hey, if we add up all the deposits in the bank, okay, and our deposits show $3 million and we're showing $5 million in revenue, we're missing $2 million. It's fine if we're on accrual, but I mean, I didn't even pay $2 million in merchant services. I know QuickBooks a merchant fee is high, but it can't be that high, right? So very important things to think about. Okay. So definitely, guys, you need to be looking at, do your deposits match your invoicing, and what do those numbers look like? You need to make sure that you're invoicing, you don't hand them a stack of invoices and half of them never got paid and were deleted. You got customers that have a bunch of chargebacks, so on and so forth. Like that'll happen. Like, hey, I'm saying that this is revenue because I'm on the accrual basis, but I've got like all these chargebacks and they didn't process properly. So again, my quality of earnings is a whole lot lower than what my financial statement is saying. And then, man, then you probably got a bigger problem with the tax man, because you probably paid a whole bunch of tax that you shouldn't have paid because you were overstating your income. Then that's terrible, bro.
As small business owners and entrepreneurs, we tend to kind of chase that roller coaster that is the business cycle. When you think about a sale process or a buyer, they want consistency. And so the more you can tell the story about, hey, there are fluctuations, there are industry happens, there are elections, the quality of earnings is how consistent is the story you can tell them, where those discrepancies are as minimal as possible.
Absolutely.
That's what they're looking for is how consistent are you? Not always necessary. I mean, accuracy is important, but that consistency is what's really going to help you cross the finish line.
100%. And that's, again, part of that 3 to 5 year process. All right, I just sold. I'm 54 years old, and I sold. I got a $2 million check. Right? Do I have to pay tax on that?
I mean, that's up to your tax advisor. The odds are yes.
Probably,
Yes.
right?
And the fact, well, I mean, we're part of that process. So
Mhm.
I would say that at Greystone, you would have had that conversation ahead of time.
Cool.
You know, and we would have planned for that. I think the bigger question is after you pay taxes and you know what your net is 90 days later, what are you doing with your life?
Man, what am I doing? And so I'm 54, right? Like, is it time to retire? Like, I retire early? Is 2 million going to get me there? Like, am I going to be able to live to be 80 on $2 million after I pay taxes and stuff at 54?
I mean, those are questions we definitely like to include your financial advisor with.
No. Short answer.
I mean,
no, you're right.
Of
You
course,
need
no,
an
but it also
advisor.
depends on your lifestyle.
Like, can you? Of course you can.
I mean,
yeah,
my mother can
absolutely.
live on a, like
No,
30K a year.
Absolutely, absolutely. But for most of us entrepreneurs, we get to 2 million. Like, we're living a pretty good life now. Is the house paid off? Is all the cars paid off and stuff? Gonna need a few more cars along the way. Probably don't need a new house. You know, there are lots of stuff to consider there. But what's the biggest problem that entrepreneurs face after their exit?
Not necessarily buyer's remorse as much as not having a plan post exit.
Okay.
Right. At that age group, you're not necessarily going to retire. My mentor went through this. You know, there's only so much golf you can play.
Bro.
You know, you're used to leveraging your intellect and getting up and going to the office and meeting clients. And so the biggest hurdle I would say is where do you focus that energy moving forward? And, you know, where do you want your legacy to go? I mean,
What are some good options? Like I don't want to do it full time no more, but I don't want to die because I'm bored, you know? Because we've seen that. I mean, we've seen people that retire and like 9 months later, they're gone. Nothing to live for.
Right.
You know?
So similar to my mentor is there's always other entrepreneurial groups that are looking for support and advice. And so I think, you know, depending on what your interest level is staying in the entrepreneurial game, is there are organizations that you can participate in. Also charities, you know, depending on, you know, what you want your legacy to look like.
Right.
There's always volunteer organizations that, you know, would more than appreciate that kind of business acumen and intellect. So it really just depends on where your passion is and, you know, above and beyond where you want your hobbies to go.
Give us the wisdom of the week. What is the most important thing that you think a small business owner needs to know about this process? What wisdom can you give them to get through this process and be satisfied when it's over? Be happy and satisfied.
The entrepreneurs that I see are the happiest, are the ones that surround themselves with the people that have been there and done that and can help them throughout this process. So the more sophisticated people you surround yourself with this process, the better the outcome. What happens is if you're stuck, it's not that you necessarily have a problem, it's that you're alone. Anytime you have a group that doesn't inspire you, it's a cage.
Gotcha. Bro, that loneliness, I feel that. Get A players, everybody. Get A players. And start early, 3 to 5 years. Make it happen. Thanks so much. We'll see you soon.
Sponsored by Centavos. Keep more of your money.